Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is the founder and chief analyst over at Capitalist Times. He writes a number of paid newsletters. He's been covering oil and natural gas stocks for over 20 years. Elliot Gue, thank you for joining me.
Well, thanks for having me on the show.
So, Elliot, we've actually had a lot of commonalities here with our friends. I've worked with your business partner, Roger Conrad, too, in the past. I've actually interviewed you years ago. Don't know if you remember. I want to get your thoughts on the oil and gas markets right now. We're recording this interview on Thursday, March 2nd, 2023. The WTI crude oil price is at just under $78. Brent crude's just under $85. U.S. natural gas futures have been all over the map the last 2 or 3 months. We had a little bit of a rally the last couple of weeks. Are there lots of companies that are still profitable at current oil and natural gas prices that you cover?
Yes, there are a lot of companies out there on both the oil side and the gas side that can make money at current prices or even a little bit lower. On the oil side, actually the high 70s, low to mid 80s is a very comfortable range for most of the U.S. shale producers. The better names among the shale producers can make money even with oil down in the $40 to $45 range, can still generate positive free cash flow. On the gas side, a little bit more variability, but you still have a lot of producers in Appalachia, in the Marcellus shale, the Utica shale there, primarily the Marcellus, that can break even, generate positive free cash flow, even with gas down in the low twos, so between 2 and 250 a million BTUs. In the Haynesville shale, which is another major shale play centered in Louisiana, it's a little higher break-evens. Free cash flow break-evens are closer to $3. But you got to remember that the front month price of gas is a lot lower than the price of gas for delivery, say 6 or 12 months in the future. So that price that you hear quoted on the news of, $250 or under $250 just a couple weeks ago, it isn't particularly relevant for a producer of natural gas, right? Because right now, the price of gas is sub 3. But if I go out to, say, January of next year, you're looking at futures trading around 430, right? So a lot higher. If I go out to, 2 years in the future, you're looking at prices over, 450, 460, 470. So you got to remember, a lot of these producers are hedging their production years ahead of time, or at least, 3 or 4 quarters ahead of time. So they're only selling a little bit of gas at current prices, and they're probably selling it. Many of them are selling it. They've hedged their production for this quarter, so they're not really exposed particularly to those depressed gas prices. So they're able to generate free cash flow on the gas side, even with prices where they are, partly because their break-even costs are even lower, and partly because they have these hedges in place.
And who are some of the low-cost producers that you cover? You mentioned natural gas in the Utica shale in the Appalachian there. Is EQT the largest one?
Yes, they're the largest producer in the Marcellus, in Marcellus and Utica shales. Marcellus is probably the lowest cost. It's the largest and lowest cost gas play in the United States. EQT it's a very high quality producer. They're a pure play on Appalachia. Their Q4, which they just reported, they had some weather related issues. If you remember, this year so far anyway, January, February has been pretty warmer than average in much of the U.S. But December was really cold in parts of the United States. So they had some production disruptions, but they're producing in a normal quarter, or in a normal quarter, an average of around 5.5 billion cubic feet of gas equivalent a day. And their corporate break-even price is down around $2.30 a million BTUs. They've hedged a lot of their production for 2023, almost 2/3 of their production in 2023. The other thing you got to look at when you're looking at hedges, right, for any of the gas producers is what those hedges are comprised of. So in other words, you can use a fixed price swap hedge, which basically locks in the price for the gas that you produce. But you can also use options, right? You can use options collars. which provide a floor. So in other words, if the price of gas were to fall below that floor, they would compensate you. And then the offset to that is you also have a ceiling, right? So you're kind of selling some of your upside in exchange for guaranteeing your downside, which makes a ton of sense for a producer that has such a low break-even cost like EQT does. In 2023, as I said, they have almost 2/3 of their gas production as of their last report, which was in February, at an average price of if they get an average price of $3 this year, they're going to get more than $575 million from that hedge book just for this year. So prices are below that right now, but even if the average is 3 through the course of the year, they're going to get over $500 million in hedge proceeds. So they are really well protected for gas prices, both for 2023 and some for 2024 as well. They have right around 20% of their 2024 production, already hedged at attractive prices.
Is EQT the lowest cost producer for natural gas that you cover, or are there companies that produce even lower than that?
Well, okay, it's a little bit sticky, if you will, because when you're a gas producer, in many cases you're not a pure play gas producer. So oftentimes in a place like the Marcellus or Utica shales, particularly, you'll produce significant volumes of what are called natural gas liquids, which would be things like ethane, propane, butane, and those products are used in things like chemicals production. They also have a very strong export market. You can load them onto a ship, and they're exported to places like Europe. Again, used to make various chemicals, things like plastics, right? And normally those are priced off oil more than natural gas. So you're not going to get for your basic natural gas liquids, a barrel of them, you're not going to get the same price you're going to get for a barrel of WTI or Brent, but you're going to get something around 33% of the price of a barrel of oil. So those are, a much higher value than an energy equivalent amount of natural gas. So with some of your producers like EQT that do have significant volumes of natural gas liquids, if you look at their pure break-even costs, it benefits from those NGL volumes because they're getting a higher value for those. So their break-even cost for gas is a little bit lower because they also have these NGL volumes to sort of supplement the cost of gas itself, or the value of the gas they produce itself. So for EQT, like I said, their corporate break-even is around 230. I actually have it around 229 based on the midpoint of their guidance for 2023. And again, they produce quite a bit of these natural gas liquids, so that also helps flatter that for them because they're not just selling gas; they're selling these oil-like products as well. There are some producers out there. CNX, for example, is a producer which may have a little bit lower cost for gas in terms of just the value of the gas they produce. I think Antero Resources is another one that has a very low cost for gas. But again, that's a name that something like 40% of their volume in 2023 is going to be natural gas liquids and even oil. So it's a little bit of an apples to oranges comparison. To compare, say, a cost of production for a name like EQT or CNX or AR, those are all Appalachia producers. And by Appalachia, I mean Marcellus and Utica, mainly Marcellus. And if you try to compare their cost of production to, say, a producer in the Haynesville Shale of Louisiana, they're going to have a higher cost of production. And that's partly because they don't have the benefit of natural gas liquids. The Haynesville is what we call a dry gas play. Which means that it doesn't have liquids in it. The gas stream doesn't have naturally occurring ethane or propane in it. One more little complication, right? Just to make it a little bit more difficult to compare all these companies. Obviously, if you're in the Appalachian region, so I'm talking about states like Pennsylvania, West Virginia, and Ohio, right? You have to transport that gas to market. There's a ton of gas production in that part of the United States, but there's not enough demand locally to absorb all the supply. So a lot of that gas has to be transported down to the US Gulf Coast, which is where most gas is used, both because you have liquefied natural gas export terminals, but you also have, a huge industrial base there, right? Chemicals companies, fertilizer companies, all major consumers of gas. So your transportation costs are going to be a little bit higher to get your gas to market versus, say, a Haynesville producer, which is sitting there in eastern Texas or Louisiana and can basically move their gas via a short intrastate pipeline to the Gulf Coast. So it's a little more complex than just saying, that EQT or CNX or Antero have the lowest cost of production because of the mix of actual commodities they produce, as well as some of the other costs. So in other words, a producer in Appalachia isn't going to get the same value for the gas they sell as a producer on the Gulf Coast.
Yeah, I agree. And refiners also want those natural gas liquids, and refiners are also using a lot of those things as well. I mean, there's a lot of innovation over the last few decades with a lot of these petroleum products. Oil has been replaced. I think natural gas is used now for a lot of synthetic for oil changes. They put in a lot of natural gas liquids and things like that into there instead of just regular oil. The synthetic is a other type of hydrocarbon. But that's an interesting point you brought up that a lot of people don't understand. So thank you for taking the time to explain that. A lot of these producers like a Devon Energy or some of these others are around 50-50 oil and natural gas for their revenues. And then they also have natural gas liquids.
Right. You're going to have a mix of even a producer that's primarily considered an oil producer. Like one name I like is Pioneer Natural, PXD. They're a major producer in the Permian Basin play in Texas, and they're in Texas, but the Permian goes across the border to New Mexico. You're actually going to have a lot of what we call associated natural gas production in that region. So while most people think of the Permian as primarily an oil play, it's actually a huge natural gas play as well. In fact, it's one of the largest in the United States, particularly the Delaware Basin part of the Permian, which is in New Mexico. I'll tell you, and this is actually a very important determinant of what's been going on in natural gas pricing, right, over the last decade. If you remember, back in 2008 to 2009, U.S. natural gas prices were over $10 a million BTUs, double-digit gas prices back then. And, for most of the period from 2010 all the way up until 2021, 2022, we had really low natural gas prices in the U.S. $2.50 to $3.50 was sort of the best you could hope for over that time period. And a lot of that was because of this tremendous growth we had in gas production, not from gas plays like the Marcellus or the Haynesville, but from oil plays. I think,
it was a byproduct. It was a byproduct.
Yes, exactly. Associated gas production is just that when you produce the oil, there's gas dissolved in the oil, and when it bubbles to the surface and the pressure is reduced, it bubbles out of solution. And we call this associated gas production. And in 2012, Permian natural gas production, and again, this is an oil field, primarily considered an oil field, was about 4 BCF a day, billion cubic feet a day. By 2021, early 2022, it was up around 18 BCF a day. So, and you're talking about a U.S. gas market in terms of production, somewhere in that 100 to 110 BCF a day range. So, suddenly the Permian is, which is an oil play, is basically accounting for close to 20% of U.S. gas production. And, that's a problem when you consider that is, what we call zero cost natural gas. A producer like Pioneer isn't producing its fields to produce gas, or they're targeting oil. So they're going to decide to drill or not to drill based on the price of oil, not gas.
So, but they have an extra potential revenue stream, though, if they can figure out how to make profits from the gas or hedge the gas prices or move that natural gas to a refiner then.
Yeah, they do. And that's exactly what they did. They tried to make a little bit of money on it, but in many ways, it would even have at times a negative cost because there were so many producers active in the Permian at that time for oil. There was a surplus of gas, and they were literally either getting rid of it in terms of flaring it off, or in some cases, when there was too much of an oversupply, they were literally paying people to take it from them. So it was sort of a low cost or a zero or negative cost byproduct. And that depressed the price of gas.
You're describing what happened basically while the U.S. was massively growing its oil production, mostly out of the Permian. The majority of the U.S.'s oil production growth was in the Permian Basin. For listeners out there, from around 2008, 2009, the frac boom or shale boom, to about 2019, production peaked about then. And during that time, I mean, a lot of hedge funds were just shorting the shit out of natural gas because natural gas was either range bound or falling. And a lot of it was what you described. It was just, there was so much shale gas byproduct that they were just flaring it off and there wasn't pipelines or places to store it.
Right. And it was what we call gas on gas competition. So you had, if you're a producer and you're in the Haynesville Shale of Louisiana, which is a gas only play, you're competing against that gas coming out of the Permian. So if there's too much gas in the Permian and they're literally paying people to get rid of it, and you're trying to produce gas, and it's going to be very hard to produce. It's going to be very hard for gas prices to sustainably be at a level at which you can make a decent profit or any profit. And that's why you had so many of those companies in financial trouble, going bankrupt in the gas space. A lot of the names that, even some of the names I like today, were reorganized in a bankruptcy process back then.
What, Chesapeake, right? That's a poster
Chesapeake,
child.
Yeah, which is one of the names I really like now. I mean, they, by going through bankruptcy, they eliminated almost all their debt. Now they're a much tighter, more tightly focused company. Back then, they had a lot of legacy type assets where these were gas plays that in the past have been very important to the United States, but now with shale being so much lower cost and plays like the Marcellus and plays like the Haynesville, they were no longer economic to produce. So they had a lot of stranded acreage in those plays. They've exited most of that, and now they do have a little bit left in the Eagle Ford Shale of Texas, which it's a decent play. They're selling that, and they're going to be only a Haynesville and Appalachia producer. They're a low-cost producer. As I said, they reorganized in bankruptcy, don't have a lot of debt. Now they're paying a very attractive high single digits dividend, and they can break even. They're as I said, they're a combination of an Appalachia and a Haynesville producer. They can break even with prices around $3. They're very heavily hedged for 2023 and 2024, so they have some protection there. And they're actually, in my view, ideally positioned because a lot of their production growth is coming from the Haynesville, and that can be used to support all this liquefied natural gas export capacity we have coming on stream over the next few years. So yeah, it's a dramatic change. We had this gas on gas competition, and the only thing that brought the end to that was, as you mentioned, we've seen peak U.S. gas or U.S. oil production. We had a very undisciplined shale sector where these companies were just going out and trying to drill and produce more and more oil for much of that period from 2010 all the way up through 2021 or so. Now, most of those producers, like Pioneer, they're very much focused on cash flow. So not focused on growing the number of barrels that come out of the ground. They're focused on generating free cash flow and paying dividends. So we don't see the same level of production growth coming out of a play like the Permian. So that associated gas production that was such a problem for all those years is finally hitting a wall as well. And that's what's allowed, that's been, I would argue, the main factor which has allowed gas prices to recover from the lows we saw a few years ago in 2020 to, see prices again in the double-digit range last year. And I think, long term, my personal view is that we'll see gas prices over the long haul, over the next 3 or 4 years, averaging north of $4.
Well, I also think the other thing is over the last 2.5 years, we've seen a lot of these other countries, they've had oil and natural gas drilling bans in their areas. And so they've been forced to import. So electricity demand globally is still growing in a lot of these countries. And you're seeing countries that one of the worst countries is Germany, because I think they spent over $500 billion just over the winter to try to accumulate coal, wood, liquefied natural gas. I think they're renting their third floating LNG terminal. So these countries are not allowing a lot of domestic drilling. This benefits the US companies that can get their natural gas to a LNG, a liquefied natural gas export port.
Yeah, absolutely. I look at it right now. Right now, you're looking at the Netherlands Title Transfer Facility, which is TTF, is their main benchmark for gas prices in Europe. And if you convert it to a U.S. equivalent, it's still $15 a million BTUs. And as we said, U.S. gas prices are under 3, so that's 5 times. Earlier last year, at one point in the Netherlands, gas prices were around $100 a million BTUs, compared to, as I said, at the highs last summer, close to 10 in the US. So again, 10 times higher. There's obviously an economic incentive in place to export natural gas from the United States to Europe because of that price differential. Obviously, if you're a producer here in the United States and you can sell your gas in Europe for 10 times the price, it doesn't cost you much at all, just a couple of bucks to ship it there and deliver it to, say, the Netherlands, to a liquefied natural gas import facility there. The problem the US has had is a lack of capacity to export liquefied natural gas. So these liquefaction terminals. And I think that a lot of people think, it hasn't been that long that the US has been exporting liquefied natural gas. We only started in 2016. And I can remember, back in the late 90s, when I first started studying the energy markets very seriously, the consensus was that the US was going to have to import a lot of liquefied natural gas, because the idea was that US gas production was falling and Canadian gas production was kind of hitting a wall. And therefore, we're going to have to import more and more gas from Russia, the Middle East, et cetera, in the form of liquefied natural gas to meet US gas demand growth. And then, of course, the advent of shale, we flipped the equation entirely from a sort of culture of scarcity to a culture of plenty in terms of the energy market. But it's taken a long time for us to develop that export infrastructure. But it is coming, right? So in 2016, the maximum amount of natural gas we could export via liquefied natural gas. So obviously, we're not connected to Europe with a pipeline. So, the US gas market has traditionally been stranded. We could sell our gas in the United States. We could sell it in Canada, Mexico, anywhere connected via a pipeline, but nowhere else. We could not take advantage of European gas prices or Asian gas prices because we didn't have the ability to liquefy gas and send it abroad. That changed in 2016. Capacity back then was around 3 BCF a day, as I said. By between 2016 and 2018. By early 2020, we were up to around 8 BCF a day of export capacity. Right now, we're around 12 to 13 BCF a day of export capacity. And over the next few years, right, really between late 2024, so late next year, and late 2025, we're looking at adding an additional 6 BCF a day of export capacity. And these are at liquefaction terminals. These aren't just plans or proposals. These are actually facilities already under construction, primarily in Texas and Louisiana. And beyond that, we could see there are proposals in place and permits in place for another 10 to 13 BCF eventually. So there's a lot of growth in liquefied natural gas export capacity coming on stream. In fact, the US is going to be a crucial supplier to countries in places like Europe, which honestly, as you said, they're having to buy all this coal, right? They're having to, in fact, as you probably heard, keep one of their lignite mines, which is a brown coal. It's a very polluting form of coal, very low energy content form of coal. They're having to keep a mine in Germany open, even after tremendous environmental opposition to that, just to meet their power demands over the next few years because of the Russia situation and the fact that they can't import natural gas from Russia anymore. And that was where they got most of their gas. So, I mean, the US is absolutely critical in terms of meeting European just basic energy demand over the next few years. And that's going to be a big source of demand upside really starting next year and into 2025. And that's a major reason why I think you're going to see those higher average gas prices over the next few years compared to what we've seen, on average over the last dozen years or so.
Yeah, I think you just laid out the case for electricity demand and global demand growth for natural gas for electricity generation, because it's kind of the compromise fuel. We were talking about Germany. Germany also shut off their nuclear power plants. So it looks like they're going to have to spend, I think the projections are now $1 trillion are going to have to commit now for a lot of their energy spending, which is an insanely large number because they shut off their nuclear power plants and they were not prepared with the LNG, liquefied natural gas import facilities. And now they're renting very, very expensive floating ones. I think they're in their third floating LNG terminal for liquefied natural gas right now.
Yeah. It's the European energy crisis. It's still there. It's still very much there. I know it's kind of come off the boil or out of the news a little bit, but the truth is that Europe is only where they are today because they got really lucky. They had a warm winter. Natural gas demand was well below normal. The winter months are gas demand is very important. Natural gas heating, electricity demand. They've had a very mild winter there. So their demand has not been anything close to what it normally would be at this time of year. And that allowed them to stay ahead of this winter. They also, as you mentioned, they imported a lot of natural gas last summer. They filled up their natural gas storage as completely as possible by October, November, at the start of their heating season. So they had a lot of a cushion there, of gas cushion, to meet demand this winter. But if it had not been a very warm winter, they would have been in real trouble. And the truth is that because Europe is so and not just Germany, but Portugal, Spain, the United Kingdom, a lot of these countries are heavily dependent on renewable energy. And renewable energy is extremely intermittent, right? So I'm talking about wind, solar, offshore wind, onshore wind, all of that. If the wind isn't blowing, then you're not generating power from wind. And what these countries are doing is they don't have any significant storage capacity. We don't have in the United States either the ability to store electricity on the grid. The grid has to balance, so demand has to equal supply at every moment in time. So if I'm a country, right, and I have a certain amount of demand for power at 9 a.m., I have to make sure that when people wake up, get ready to go to work, right? I have to make sure that there's enough power available at that time to meet that demand. And so if the wind is blowing, consistently in an area, then I don't have to use very much natural gas or coal or any other source like that at all. I can depend upon wind for a lot of my power. But if wind isn't blowing, right, I still need to create enough power to meet that demand. I can't store energy, so I have to fire up natural gas plants and feed more power into the grid. And so that's why, they build humongous amounts of renewable energy capacity to the point that their electricity costs are 2 and 3 times the US average at the residential level. Despite all that huge growth in capacity, they still have to maintain all these natural gas, mainly facilities, as what we call shadow capacity to meet demand when there's not enough power coming from these renewable plants. And I wrote an article about this a while back on one of my on my Substack product, but basically talking about you've probably seen or heard or read or seen on Twitter or whatever. People say things like, last year Germany generated 30% of their electricity from wind, and that is the most misleading half-truth you could possibly imagine, because some days they generated 90% of their power from wind. Other days, they generated 1 or 2% of their power from wind. And that doesn't, so it just
doesn't
because
sound reliable.
It isn't reliable. And that's the
sounds
thing.
worse than a coin flip.
It is. And in fact, one of the interesting things, if you think about it, when do we use a lot of power here in the United States, right? It's when it's hot, right? You want to turn on your air conditioner. I know all about that down here in Florida, trust me, but you want to turn on your air conditioner when it's hot outside. But, why do you get heat waves? You usually get heat waves because there's a high pressure system parked right overhead. And when there's a high pressure system, by definition, usually there's very little wind. So in a lot of cases, in a lot of these countries, and this happened a lot in the spring and summer of 2021, so not last year, but the year before, they had these heat waves and they had almost no wind generation whatsoever because, there was a high pressure system parked over Europe, which was causing that heat wave, those very high temperatures. So right when demand was highest, their wind output was lowest. And I mean, this is almost ridiculous to me. I lived in the UK for a while, and it's almost ridiculous to me to think that these countries, which are developed countries, are literally in a position of saying, if the weather is bad, we may not have enough power because most of our power comes from these, intermittent renewable sources, and we don't have enough domestic gas production or coal production.
They're phasing out their nuclear power plants too, which is even more of a head. So they're phasing out all the traditional baseload electricity generation, and they're betting everything on ESG. But as you described, I mean, this is worse than a coin flip, that they could have no electricity, no power for days.
Right. Literally, if it rains or is hot, right. So, or if it doesn't rain, rather.
Or birds fly into the windmills and destroy the windmills. So, I mean, like there's, and these solar panels also break down quickly too. These things don't last for decades.
Yeah. And, the Earth's little habit of rotating on its axis every day. So obviously for long periods of time, in a place like Germany, it's night and therefore you're not getting any solar output. So it's very expensive, inefficient. And when you see people say, oh, well, solar is cheaper than natural gas, that is before you take into account the fact that you have to build natural gas facilities to offset the fact that the sun isn't shining all night long, right? So they're not factoring, it's not an apples for apples comparison. Obviously, sunlight is free. You walk outside, you don't have to pay because the sun is shining on you. But that doesn't mean that solar power is free because it's only generated at certain times of the day. There's no way to cost effectively store it.
Well, the panels are also made through a lot of unenvironmentally friendly mining in China where
yes.
They have bad environmental laws. So you're using tons of plastics and petroleum products to mine the rare earth elements, and in the air, water, and soil all around the mine is totally toxic or radioactive with the thorium as a byproduct. And then you have to have specialized people, in the value chain, even turn that stuff into a solar panel. So
that's exactly right. And I think if there's one good thing that came out of all that is that because Germany, I mean, it's an epic fail. I mean, there's no other way to put it. They shut down, they started doing this over a decade ago. They agreed to shut down all their nuclear power capacity. They have one plant operating right now, I believe still for a little while. They shut down all their capacity. They built all this solar and wind, and they've had all these problems. And prior to this crisis, I mean, it's almost hard to believe, but they were trying to convince the French to do the same thing. And the French have a huge nuclear power capacity because they really pursued that technology back in the 70s. And one of the things we've seen is countries like Japan, France, right, even Britain, that look to be going the German route of maybe abandoning nuclear power are now moving back that way. So if there's one good thing to come of this, it might be that some of these countries are starting to think twice about following the Germans, I think literally off a cliff. It's sad to see what's happened.
And they're losing a lot of their major chemical companies like BASF, and they're having major factories that are not competitive there because they don't have that cheap natural gas and cheap electricity. So factories are either going to be shutting down or they're moving, or companies are going bankrupt because they can't compete on a global level or international level with a lot of these other manufacturers that, like here in the United States or other countries, that have cheap electricity and cheaper natural gas. They're just not competitive anymore.
Oh, yeah, absolutely. I mean, I'll give you two examples. You mentioned refining earlier. US refiners, other refiners around the world do use a lot of natural gas liquids, but a lot of people don't remember that a lot of their cost is actually natural gas itself. The refining business is a business of heating stuff up and cooling stuff down, right? So you take this raw crude oil and you heat it up, and molecules of different lengths will rise to a different level in a distillation column. That requires a lot of heat to do that, to bring oil temperature up, and then you move it through a cooling coil, and that they use natural gas for that. So literally, the high cost of natural gas makes refining very expensive or literally uneconomic in many European countries. Over the last few years, they've shut down a lot of their refining capacity, which makes them dependent on imports from places like the United States, the Middle East as well. Another example, which I think could be very critical to keep in mind, it's not an industry a lot of people talk about, but fertilizer. Particularly nitrogen fertilizer is made using either natural gas, coal, or oil, okay? And obviously, US natural gas prices being so low, it's cheapest to produce fertilizer here in the US than anywhere in the world, even cheaper than Asia. Europe has had to shut down a bunch of their natural nitrogen producing plants because they can't produce nitrogen fertilizer profitably at gas prices they pay for there. And the US benefits, we export a lot more nitrogen fertilizer to Europe. But if you don't have nitrogen fertilizer, you literally can't feed your population. So it's another crucial industry that's been kind of hollowed out by this energy crisis there.
So it sounds like long-term liquefied natural gas demand is not going to go away, even if prices go low for a short amount of time here in the United States, that if that gas producer can get that natural gas to a liquefied natural gas export facility. And the other point that we didn't bring up was the Freeport liquefied natural gas facility. That's a big one that's been offline, for the last 8 or 9 months. If that comes back online, the U.S. will have a lot more export capacity as well.
Yeah, the Freeport went offline, and that's about a 2 billion cubic foot a day facility. And that went offline in June. And it's just coming back online now. They just started accepting their first deliveries in February of gas. And the first couple of ships sailed into the terminal there to pick up LNG. And they're expected to get back to full capacity in the middle of this month, maybe the end of this month. However, I think this is an important point as well. I mean, if we look at the main reason why U.S. gas prices are so low right now is the amount of gas we have in storage. So, literally the most important fundamental for near-term gas prices is, what's the current level of gas we have in storage in the U.S. and what's the 5 or 7 year average? And right now, because we've had a warm January and February in the United States, gas storage is around 300 billion cubic feet above the 5 year average. And that's with a warm winter. But since last June, we've lost about 400 billion cubic feet, maybe a little bit more, of total exports from Freeport. So what I'm saying is, if it weren't for Freeport, right, going offline with the fire last June, and the weather being warm, just imagine how low natural gas storage will be right now. And I think it's important to separate commodity factors into sort of cyclical or short term versus structural or secular factors. So I would say, that gas on gas competition we were talking about in the Permian, where you had all this growth in associated gas production, that was a secular problem which impacted the gas market for more than a decade. But the Freeport terminal being offline is a short-term problem because it's back online now. The weather this winter is a short-term issue because, what if we have a hot summer and gas demand like we did last year and gas demand is higher than normal? You could change the picture entirely. But there's no structural overcapacity or oversupply of gas today as there was, say back in 2016 or 2015 when gas prices were, at 2. It's really a short-term issue. And, over the next year or so, as we have more liquefied natural gas capacity coming back up, by which I mean the Freeport terminal, and also, more normal weather conditions, presumably, and, the potential for European demand to pull as well. It's very likely that the U.S. gas storage is going to look a lot healthier, say 6 or 9 months from now than it does right now. And, to some extent, that's already factored into the futures market. If I look at the futures curve, right? So I look at the prices for futures for delivery in all months. As I said, right now it's very low, but, by next winter, it's already back over $4, which is a very healthy price for many of these producers.
So Cheniere Energy is just booking a lot of deals from the Chinese national oil companies, from I think a Canadian oil producer, because Vancouver also has the liquefied natural gas, a smaller one right out in British Columbia coming online. So besides Cheniere Energy, because that stock's already really, really high, I mean, I think they're going to be consistently profitable going forward for many, many years, because a lot of their deals are doing are not spot futures. They're kind of they're long-term contracts. Are there any other liquefied natural gas plays you like that you cover?
That's the only one I would really get involved with now. There's some smaller names, and a lot of them are looking at developing, for example, these floating LNG liquefaction terminals. I think that could be more important going forward because they're a little faster to bring into service. The downside of them is that obviously they don't have the capacity of a big onshore terminal like a Freeport or the Golden Pass terminal they're bringing online in Texas in late next year. So LNG is the name we like. I think that our two favorite plays on LNG specifically would be on the producer side. I want to look at producers in that Haynesville shale play in Louisiana, because those companies are the ones that are right there, right? And are selling directly into that Gulf Coast market. And that's where almost all these LNG terminals are located, right there. In fact, over the next 5 years, about 70% of US gas demand growth is going to be attached in one way or another to that Gulf Coast area, whether it be all the refining capacity, all the fertilizer capacity, all the industrial capacity on the Gulf Coast. You want to be right there. And that's why, even though the cost of producing from the Haynesville is a bit higher, I think those companies are going to benefit a lot. Names like Southwestern, also Chesapeake, as we talked about, are going to benefit from that. Also, I do think that the midstream business is another thing that we cover. And I do think that is going to benefit from all the gas being moved around, right? So companies that own the pipelines, gas treating facilities, gas processing facilities, right, in these areas are going to benefit from those increased volumes flowing into those LNG export terminals. So, names like Enterprise Products is, one of the biggest MLPs out there. EPD, they've got a yield of 7.5% right now, very consistent grower over time.
Now, we're seeing with the Fed raising interest rates, we're starting to see some of these companies, whether it's Intel, and we're recording this interview again on Thursday, March 2nd, 2023. We're seeing companies like Intel and others talk about lack of sales, debt on the balance sheet, interest payments. I think Enbridge, which is another pipeline company, their senior executives were playing around with variable interest rate debt on their balance sheet, and now they have much higher interest payments. They're talking about a dividend cut. Are we going to see a lot of dividend cuts from these oil and natural gas producers or some of these pipeline companies because they over-leveraged their balance sheet with variable rate debt?
On the producer side, I don't think you have a humongous amount of problem with on the debt side, partly because a lot of these companies have paid down most of their debt over the last few years. They've used this tremendous free cash flow boom that we got, in particular last year, to pay down their debt to well below the average for, say, the S&P 500 or index like that. The other thing is most of those companies have fixed rate debt. In many cases, a lot of my favorites, names like Chesapeake and Southwestern, for example, a lot of their debt, it doesn't mature until 2028, 2029, or even later. So they shouldn't have too much trouble with interest costs specifically. You do have some of the pipeline companies that have exposure to rising interest rates. And the key there is really to pick the higher quality names, in my view. There are companies, there are MLPs out there, which, we've recommended avoiding, names like NGL, for example, NGL Energy, the symbol is NGL. And then there are names that, like Enterprise, which actually, even though the stock's still down from where it was a few years ago or back at the highs in, 2014, 2015, their dividend is actually a lot larger than it was back then. And they're probably likely to continue growing their payout over time. The one thing that I would point out is that some of the MLPs, names like Enterprise Products Partners, they generally look to have a sustainable dividend, and they kind of gradually increase it over time. But some of these producers, what they've done over the last few years is they realize that investors want to benefit from rising commodity prices. In other words, a lot of people, you go out and buy a gas producer and the price of gas goes up a lot. You want to see some direct benefit from that. So a lot of what they've done to return capital to shareholders is they have initiated variable dividend plans. And so what that usually means is that they have a certain base dividend, which is maybe 2 or 3 or 4% yield. And then on top of that, they say they'll pay out, say 50% of their free cash flow as a variable dividend every quarter. So you will see companies, and so Chesapeake
is kind of a performance bonus then.
Exactly. And so you will see companies like Chesapeake cut their dividends, right? Because even though they're maintaining their base dividend, that variable dividend is going to go up and down somewhat with the price of gas. For example, Chesapeake paid back in December, they paid over $3 a share dividend total. And, this quarter, later this month, they're only going to pay $1.29. That's all due to commodity prices. If commodity prices go back up to 4 or 5, you say early next year, they might pay, $3 or $4 for the quarter. It really is going to depend. There's going to be a variable component, which is going to depend on the price of gas. Some of them also do a combination of, they return some of their free cash flow as dividends and some as share buybacks. Some of them do kind of a 3-way capital return where they pay down debt, have a variable dividend and do buybacks or some combination thereof. It really is a company by company thing. In my mind, you just have to be prepared for that. Even with this lower dividend, right? Chesapeake is still yielding, 6.5%. So, it's still a great yield that compares very favorably to what you're going to get out of most companies, right? But it's obviously it's a little lower than what it was last quarter because the price of gas is lower.
So this isn't a situation similar to kind of the height of the shale bubble, 2017, 2018, 2019, where a lot of these oil producers, they may have had bad hedges on, natural gas prices were falling. They had a ton of variable interest rate debt on their revolving credit facility and elsewhere. And a lot of people are talking about either equity dilutions or bankruptcies. So we're nowhere near that scenario because a lot of these companies kind of over the last 2.5 years, they had their free cash flow. And when oil prices went negative, in early 2020, and people were talking about worst case scenario for oil, they went lean and mean. Then they started paying down debt, trying to fix their balance sheet, trying to become more efficient back then.
That's exactly right. The industry has changed a lot since the shale boom years. Back in literally in 2016, 2017, that kind of period, you could take a spreadsheet and look at the companies that had the fastest growth in production in terms of barrels. Back then, it was mainly oil everybody cared about, but the number of barrels of oil coming out of the ground, how much did it grow year over year? And look at their stock price, and they would be highly correlated. And I travel around to these various industry conferences and whatnot. And, everybody's trying to pitch. I always enjoy just listening to what people are trying to pitch me, right? What do they want to tell me? What's their story? And it was always, well, we've drilled these new wells here and we think that we can grow our production, 25% next year, right? it was never about, we can drill some more wells, but we can also generate another $100 million of free cash flow. It was all about growth. And so what they were doing was they were generating operating cash flow, obviously, and then they were turning right around and putting that into new wells, then borrowing money based on their production to drill even more wells. It was all about growth. And what happened is started changing in 2014, 2015, when the price of oil really plummeted. Price of oil came down very sharply. And suddenly, producing more oil didn't look so great, because if you're not making money on it, then what good does it do to produce more barrels of oil into an oversupplied market?
And
so what they started to do is change their model gradually. And then, of course, as you said, the 2020 collapse kind of, the better names had already started changing in that 2018 kind of time frame. But by 2020, everybody had to change. It's all about free cash flow now. It's all about, these companies are some of the most conservatively managed companies. They're kind of all managed like Exxon was back in the day, and they're all 100% focused on free cash flow. Some of these companies, I was looking at Chesapeake. They announced just a few days ago, and they announced their 5-year plan, right? So their 5-year guidance, if you will. And between 2023 and 2027, so 5 years, right? They're going to generate $6.1 billion of free cash flow, even with gas price, even if they hedged all their production for the next 5 years at current futures prices. And they've got as I mentioned, some deals to sell some acreage in the Eagle Ford Shale, which they're exiting. They've already closed 2 of those for $2.5 billion. They could pay, even if gas prices were around $3, they could still pay their base dividend and some level of variable dividend. If gas prices remain kind of where they are, where the futures curve is currently set, in other words, where the current strip is, we call that the calendar strip. In other words, the futures price, the average futures price over a period of time. They're going to be able to return in a combination of variable dividends, and share buybacks. They're going to be able to return 62% of their current enterprise value over just that period of time. How many companies that can buy back, literally retire all their debt and buy back half the stock over just 5 years of operating cash flow? I don't know of any other industry that's valued in that way. Tech companies, a lot of them generate little or no free cash flow, and they're talking about potential growth over the next 20 years. A lot of these energy companies are talking about literally paying. They could generate enough cash to pay down all their debt and buy back half their stock over the next 5 years. It's tremendously conservative.
Sorry to interrupt you. I think Silicon Valley's in actually like a bear market phase. They're in a recession or depression phase right now. We're just seeing the headlines here, thousands of workers being fired, commercial office space being canceled, locations. They're cutting back a lot. So whereas the oil industry, from what you described, sounds like the oil industry is being very efficient compared to a lot of these other industries. They've learned their lesson, at least for the time being, compared to the past.
Yeah, and that's a good example. I think that the technology industry is currently in a phase similar to what maybe the energy industry was, 10 years ago or 8 years ago, in that they're going through a reckoning right now. And I think from a U.S. national perspective, it's interesting to look at. I was looking at the other day. I put a piece up about it. Just the money that companies like Microsoft, Amazon, and Alphabet, Google have spent over the last 10 years or so on research and development, right? And you compare that to the amount of capital spending we've seen from Exxon, Chevron, the big US oil companies, right? And the amount of capital spending and investment in new production capacity, technological advances in terms of extracting more oil and gas from a company like Schlumberger, SLB. And it's plummeted on the energy side, and it's just absolutely gone parabolic on the tech side. And personally, I think what you've seen is because interest rates have been forced down to zero or negative, because we've had this easy money, it has lowered the capital cost for these technology companies tremendously. They've had, growth stocks, which have distant future earnings, are valued at a much higher multiple when interest rates are very, very low, when the discount rate is very, very low. Meanwhile, you've had energy companies have been starved of capital, especially since the 2014 energy price collapse. You've had ESG type investing strategies, if you will, directing money out of energy and into technology. Energy shrank down to 3.5% of the S&P 500 at one point, right? Technology is by far the largest sector in the S&P 500, upper 20s% in terms of weighting in the index, and even more if you throw in names like Amazon. I think there's going to have to be a reckoning over the next 5 or 10 years where the world needs, and the US needs, more investment in energy production if we're going to meet not only our demands, but also save the Europeans, et cetera. There's going to have to a lot more investment in these old economies, that industries like energy that have been starved of capital. And probably, as you were talking about, more of a reckoning in these high growth industries like technology, which have probably overhired and really had a bubble in terms of their spending overall. And I think that's maybe one of the most interesting shifts I've seen in my career, is just how industries go through these, boom and bust periods, and it's not necessarily all at the same time.
Yeah, I agree. I think there's a lot of problems on the supply side for a lot of commodities, and it's not just energy. So there's fertilizer companies, although that's energy related. So the US fertilizer companies have an advantage with much cheaper natural gas prices here. So we can export more fertilizer, but also key commodities like copper. So if these politicians and bureaucrats want to force a lot of people to switch to electric vehicles, I mean, there's not enough energy at the power plants. There's not enough copper or silver to give everyone an electric vehicle to switch to.
No, that's exactly right. I mean, if we see the kind of growth that people are talking about in electric vehicle production, the strain on certain resources like cobalt, for example, which comes from the Congo, which is not exactly the world's most stable country, right? It's going to be tremendous. And I think another thing that a lot of people don't fully grasp is that the supply side, and you're very right about all these commodities, is very difficult in the commodity sector. In other words, it takes time. If I want to produce more oil, I cannot go out tomorrow and decide to produce more oil in significant quantities. It's going to require billions of dollars of capital and years to develop a new project. So you look at a company like Exxon, one of the only major oils out there who continued investing straight through the downturn. And so now they have this huge project in Guyana, right, in South America, which is probably one of the lowest cost major oil projects in the world. And then you have the European companies, Shell, BP, for example. They stopped investing in oil and started investing a lot more in renewables and things like that. And, they don't have those new projects to come on stream right now. Now, I saw Shell has started to increase their investment in traditional fossil fuel development. BP has as well. And so it's not going to make a difference this year, next year, the year after that, or even the year after that. It's only going to make a difference by the end of this decade. So that's why you have the supply side is crucial to commodities. That's why you have these really long-term super cycles in commodities like oil, natural gas, copper, iron, really even precious metals, right? Is because it takes a long time for the supply side to adjust. So demand can change on a dime. Energy demand will go down if there's a nasty recession. It'll recover right back and even higher the next time there's a recovery. China locks down, energy demand goes down. China opens up, it soars again, right? Supply can adjust like that. And I think one of the best indications that there's a supply problem coming down the highway is that if you look at Saudi Arabia, right, Kuwait, other OPEC countries, the UAE, right, they're investing more than anyone else right now in developing more oil and gas production capacity over the next 3 to 5 years. And, you have you have some governments asking why they're doing that, because we're not going to need all this oil. Of course we are, and they know it full well. The reason they're doing it is because they know the world is going to need this oil, and who knows better how much demand and supply of oil is, right, at any given time than Saudi Arabia, one of the world's largest producers.
Well, didn't the Saudi oil minister, he also said in the last couple of months, he said that they don't really have a lot of spare capacity left. So you brought up 2014, 2015. Right. That was also the time during the shale bubble as it was growing production and they were doing it inefficiently. The Saudis were also trying to bankrupt the shale companies. They were increasing production too and trying to flood the market and take market share. And they were trying to bankrupt the shale production companies too. So you had a lot of oil and that's what caused the bust, all this extra supply. Well, the Saudi oil minister has said recently they don't have, even though they're spending all this extra money on CapEx, they're actually drilling a lot of deep water offshore wells that are higher cost to replace Gawar. Yeah. So they don't have the spare capacity, even though they're investing in CapEx, they don't have the spare capacity to rapidly increase production.
No, that's right. And, spare capacity being the traditional definition is that this is oil capacity, production capacity we can bring online quickly and maintain for a prolonged period, say 30 or 90 days, whatever. The reality, though, is that a lot of spare capacity in OPEC that's claimed is a myth. Nigeria claims it has 250 or 300,000 barrels a day of spare capacity. It doesn't. It hasn't been able to produce at its technical capacity limits for 3 or 4 years now. The fields are old. They have lots of political problems, infrastructure problems in Nigeria that prevent it producing at anything close to their claimed maximum capacity. The only spare capacity in the world is in places like Saudi Arabia. And so you have, last July, remember the headlines, Joe Biden went over to Saudi Arabia and was basically asking them or begging them to produce more oil to bring down the price of oil. You probably remember seeing those headlines. And it was all this stuff about, whether he was going to, the crown prince of Saudi Arabia, whether he was going to shake his hand or fist bump him, or it was ridiculous, right? The reality is that last summer, Saudi Arabia was producing more oil, right, more consistently at an average rate for 3 months than it ever has in its history, ever. I'm talking about going back to the 60s. So Saudi Arabia was probably their maximum capacity for any length of time beyond maybe a short surge is somewhere in that 11 to 11.5 million barrel a day range, which is exactly where they were producing. They were already producing at maximum capacity. Now, I'm not going to tell you that they can't go out and maybe produce 12 million barrels a day for short periods of time. But the idea that the Saudis are withholding, which, the U.S. administration and a lot of Western governments were saying, right, that they were withholding 1 million or 1.5 million barrels a day from the world market last summer, it was insane. They were probably producing at a rate that was way higher than they were comfortable producing. And so what they're doing now is they're trying to increase their maximum capacity so that they actually do have some spare capacity to bring to bear, both for them to be able to better control the global oil market. In other words, their control of the global oil market comes from their ability to flood the market, drive down prices, or take oil off the market and drive up prices. And it's an implicit threat. Right? So in other words, if you're another OPEC country and you keep cheating on your production, the Saudis can destroy you, right? And it's the same for the US shale producers. And they want to maintain that control, that power. But the idea that they are withholding millions of barrels a day from the global market, and that's somehow why oil prices are high, is complete fantasy. The reason oil prices are high is because nobody's invested in new oil production outside of a handful of projects. And remember, existing production declines every single year just due to natural decline rate of fields. Nobody's invested enough to replace that falling capacity for years. And it's going to take many years of investment to fix that. And I think it's going to take higher prices because the only way, right, to incentive that level of investment in capital spending is to have the price rise to a level that it makes economic sense to do so. The spare capacity is a major and I think widely overlooked issue.
And it's also cheaper for a lot of these US and Canadian mid-tier or larger producers to go and buy discounted oil reserves from a publicly traded company than to go and invest, to go and drill wildcat wells or spend a lot on exploration. It's just cheaper to go buy when Wall Street is discounting these stocks so heavily.
Yeah, you're seeing more of that. You're seeing rumors of that as well. There was a rumor last week of Pioneer, which is a company I've recommended for a while, wanting to buy Range Resources, which is a gas producer. They've denied it, and the price has kind of reverted. But I do think there's a lot of sniffing around going on in the industry, and particularly on the gas side over the next year or so. As prices remain a little bit discounted near term, you're going to see some more deals. You're going to see more M&A. Right now, the market's very hostile to that because mostly investors want to see these companies just generate tons of free cash flow and pay higher dividends, right? But over time, I do think you're going to see that M&A really perk up. And you're right, investing in projects, greenfield projects, is very expensive. I think Exxon, and this is one reason I've recommended that stock for a long time, was extremely, had a lot of foresight in doing so. Remember, they were getting yelled at from all corners to stop investing so much money in Guyana, right? In this project in Guyana. You had that activist hedge fund that actually succeeded in putting board members on Exxon's board, wanting them to spend more time talking about the climate impact of what they were doing rather than investing in these fossil fuel developments, wanted them to invest more in renewable energy development. Exxon has been one of the only big oils to invest through the downturn. And the reason that was so good for them is, when oil prices are $40, $50 a barrel, it's a lot cheaper to go to a country like Guyana, pay to have all these rigs brought down there, pay for all the services, all of the pipelines, all the infrastructure you need, and to strike a deal with the local government there, right, to develop this field, than it would be at $80 or $100 a barrel. Now everybody knows how valuable their reserves are. So it's very difficult, especially with the service market as tight as it is right now. The market to do things like drill new wells, explore, develop new fields, develop infrastructure, all that. The costs have gone up a lot over the last 3 or 4 years. And, companies that are trying to do it now, starting now, they're already facing much higher costs than Exxon did 3 or 4 or 5 years ago.
And Exxon had, I think, another large discovery off the coast of Western Africa. But you brought up a valid point. The oil services companies and the drillers like Schlumberger, they just announced recently in the last couple of weeks on their earnings call, they're going to be raising prices a lot. So that's something the oil industry is going to have to deal with. I mean, the consumer is not going to have cheap gasoline, cheap natural gas for forever if the cost of drilling new wells and completing them and other oil service stuff is going up.
Right. I think that in other words, because investment has been so low for so long, investment from the major oil companies heading up to the 2013, 2014 peak was sort of in the $500 billion range annually. I track about 35 or 40 companies, and their combined CapEx at peak was around $500 billion, $500 billion. After the crash, it went all the way down to $250 billion. Which isn't a huge surprise, right? Obviously, commodity prices go down, you're going to see a drop in capital spending. What is a little bit of a surprise is that it hasn't recovered much since that time. Since bottoming out around 2016 or so, it hasn't really recovered much at all. And so that's every year since 2016, we've been massively underinvesting in new capacity. It's going to take years for that to reverse. And industries like Schlumberger, right, services industries, they don't have necessarily the capacity to meet all that demand for new development. It's certainly not at the current price. They don't have a lot of surplus machinery in some cases. You've had things like a brain drain, like a lot of people in the energy industry tend to be older. And the experience and a lot of the experienced players anyway, and a lot of them retired, right, during the commodity price collapse. Took early retirement.
In 2020, you also had a lot of the oil service workers, they went into home construction instead because there was still the housing boom with the low interest rates before the Fed started raising interest rates. So people left oil because oil went negative and everyone was slashing costs. And then those people went into home construction.
Yeah, and now you got to hire them back, and they're not going to come back for the same price they or the same salary or whatever that they received in 2020, because they know full well how much their labor's worth, and so that's raising costs
plus
across
inflation.
The board. Yeah, I'm looking. A lot of the guidance we've had on the natural gas side. I mean, you're looking at 10-20% increases in their total capex budgets, and a lot of that's just inflation. It's not that they're drilling more wells or necessarily bringing more equipment to bear or anything like that. It's just that, the cost of everything's gone up.
Well, Elliot, you are a wealth of information. I've kept you for over an hour. If my listeners want to check out your paid newsletters, how do they do so?
Well, the paid newsletter is Energy and Income Advisor, and with an O, so advisor.com. I also put up a lot of free commentary on my Substack, which is freemarketspeculator.substack.com. All the content I put up there right now is free. Put a lot of our energy-related commentary up there, usually just a few days after I post it to our paid newsletter website.
And you write for the Capitalist Times over with my former boss, Roger Conrad. So keep up the good work, man. We'll definitely have to have you back on. I really enjoyed this discussion about the energy markets.
Oh, I did as well. Thanks for having me on.